Hello, everybody. My name is Tyler Parks, and I am the manager of government relations here at the Tax Foundation. I want to thank everybody for joining our panel today, exploring the new sales tax environment created by the 2018 Wayfair Supreme Court decision. This discussion is a part of the Tax Foundation's Talking Tax Reform event series that features Tax Foundation staff and tax experts from academia, government, and private industry discussing timely tax topics in federal, state, and global tax policy. Our recent events have covered the federal debt, the tax filing season, and energy tax policy, as well as a host of other issues. If you'd like to learn more, please visit the events tab on the Tax Foundation's homepage. A few housekeeping items before we get started today. If you'd like to ask our panelists a question, please use the Q&A function at the bottom of the screen, and we will try to get to every question that we receive. Also, the webinar is being recorded, and we will release it publicly on our website and our YouTube page. So if you'd like to view after, it will be sent out to all the registrants. I'm honored today to introduce our two panelists, Manish Bhatt and Brad Scott. Manish is a senior policy analyst with the Center for State Tax Policy at the Tax Foundation. He holds an LLM in taxation from Georgetown University Law Center, a JD from St. Thomas University College of Law, and a bachelor's degree from George Washington University. Prior to Tax Foundation, he worked at a Big Four accounting firm advising clients on corporate taxation matters, served as a judge advocate in the Coast Guard, advised startup businesses, and taught business law at Texas Christian University. Brad Scott is the Director of Finance at Halstead Bead Incorporated, an e-commerce wholesaler supplying jewelry businesses worldwide. Halstead is a second-generation, family-owned small business, and Brad has been with them for 21 years. Currently, he handles multi-state sales and income tax registration, filings, reconciliation, and all other accounting for the business. He also leads Halstead's legislative advocacy efforts to achieve multi-state sales tax policy uniformity and simplification, and is the chairman of the Committee on Tax Policy at the American Catalog Mailers Association. Scott graduated from Michigan State University with a bachelor's in finance. And with that, I will hand the reins over to Manish to introduce our topic and begin our discussion. Manish?
Thanks, Tyler. I appreciate it, and I appreciate everyone being here. Brad, it's always good to see you, and I know we're going to get to a great conversation, so welcome.
Thank you.
Before we move too far into the presentation, into the Q&A section, I wanted to sort of level set. I know that there are a lot of people on this call that deal with sales taxes in their state or taxes in general. And so I just wanted to, for posterity, for the fact that this is being recorded and that there may be people who watch this in the future with less familiarity with what we're about to talk about, take the time to really introduce the topic at a 30,000-foot level, and then turn it over to Brad and I for a Q&A. So Tyler, if you could please load that slide deck one more time, please. Thanks. So when we go to the store, we're all very used to making a transaction as customers in the states we live in, if we live in states that have a sales tax, and getting a receipt back that shows what portion of our overall bill that we paid was the sales tax. And that's sort of all we think about it. We leave there, we go home, and we don't think about what happens to those dollars and cents after we leave the store. But in a very real sense, the retailer who made the sale to us has an obligation. The first obligation was to collect the sales tax from us. The next obligation is to remit that sales tax to the correct jurisdiction. For a long time, we only thought about it as us going to a store and buying these goods and then returning home with the goods that we've bought. And as we all know, the analog age has given way to the digital age, and the rise of e-commerce has made the collection and remittance of sales taxes all the more difficult and all the more important for states to strike a balance between collecting and remitting without overly burdening not just retail establishments within their state, but also interstate commerce. And so a lot of what we're going to be talking about today is how the world has changed since the Supreme Court ruled in the Wayfair decision, and what steps may be taken to alleviate the burden on retail sellers, out-of-state sellers, and what are known as marketplace facilitators. And so to do that, I just kind of wanted to present two definitions of terms that we are probably going to hear come up quite a bit over the course of the next hour. These are my definitions, these are my words, but they are, in a sense, a way of thinking through these issues, and they're different but related. So the first one is a remote seller. A remote seller is a business that does not have a physical presence in a state or in a particular state, but that is transacting sales to that state. So an example of this would be hastily, which Brad represents. The next term is marketplace facilitator. Some states call these businesses a marketplace provider. These are businesses that offer a platform, and this platform is used by remote sellers or in-state retailers to make sales to customers. An example of that that we're probably all familiar with is Amazon. So these are two definitions that are going to be key to sort of think through the landscape of sales taxes post-Wayfair, pre-Wayfair, and how the complexity in the marketplace has been generated. The important thing to remember is that while these terms are related, there are some real differences in what policy solutions may be most applicable or most effective to serve taxpayers that identify as remote sellers and others that identify as the aggregator of many remote sellers. So next slide, please, Tyler. All right, so South Dakota v. Wayfair 2018 decision upended decades of Supreme Court precedent. Prior to the Wayfair decision, in order for a state to require a retailer to collect and remit sales taxes, the retailer had to have something known as physical nexus, just physical presence within the state. If you were to go across state lines and buy an item, or if you were to order an item from a remote seller and that was delivered to your home, you as the consumer in many places were responsible for effectively paying something known as a use tax, paying for the privilege of using in which you live. Now, as we can all imagine, compliance with use taxes was and is relatively low at the consumer level. Either consumers don't know of the obligation or they don't know how to comply effectively, but in any respect, compliance with use taxes was relatively low. Now, as e-commerce became more and more of an issue, as the digital economy really started to take shape, some states took some legally tenuous routes to trying to create physical nexus for out-of-state sellers. These include things like cookie nexus, where by placing a cookie on someone's computer, a remote seller was considered to have a quote-unquote physical nexus within the state. Another one was click-through nexus, whereby using an affiliate in a state could open a remote to physical nexus standards within the state. And this, again, was because physical nexus was the standard. And this follows a progeny of Supreme Court cases dating back decades. The Wayfair Court came in and recognized that the rise in e-commerce created disparate treatment between out-of-state remote sellers, marketplace facilitators, and in-state retailers. And that with the number of transactions that were happening online with out-of-state retailers, states were starting to see their coffers suffer, starting to see losses in revenue from sales taxes. And again, placing in-state retailers in disparate means. So what the Wayfair Court established was they did away, overruled physical nexus standards and implemented what's known as economic nexus. And economic nexus is satisfied when a remote seller or a marketplace facilitator exceeds certain thresholds, meets or exceeds certain thresholds in annual sales and or transactions. And I'm going to get to the and or part in a little bit. But again, economic nexus is when a remote seller marketplace facilitator meets or exceeds annual sales and or transaction thresholds. And if they do that, then a state can obligate them to collect and remit sales taxes. What's important beyond this is the Wayfair Court established economic nexus as an opportunity for states, but did not clearly articulate a standard through which states could require remote sellers and marketplace facilitators to collect and remit sales taxes. They essentially affirmed South Dakota's statute without creating a national standard that could be implemented by the variety of jurisdictions across the land. And that creates some problems. Next slide, Tyler, please. So in the immediate aftermath of Wayfair, again, 2018, we're in 2023, we're not that far removed from the decision. We've seen states quickly enact or implement legislation that allows them to obligate collection and remittance of sales taxes by remote sellers and marketplace facilitators. And we see this patchwork has resulted in a really glaring and concerning lack of uniformity amongst the different states and taxing jurisdictions. We see this in a variety of areas, and I wanted to highlight a few of these. So the first area where we see a lack of uniformity is in the thresholds themselves. Remember, economic nexus is met when there's a certain sales threshold and/or transactions threshold, and the states, unfortunately, have not come to a uniform standard on what those thresholds are. Maryland is one example, and I don't mean to pick on Maryland and New York or any state that I mentioned today, but let's look at their standards: $100,000 in sales or 200 transactions. So you meet as a remote seller or marketplace facilitator, Maryland can obligate you to collect and remit sales taxes if you transact $100,000 in sales into the state, or if you transact 200 transactions. Now, the 200 transactions is particularly problematic because if you are a remote seller or a marketplace facilitator transacting 200 transactions that are each worth $5, then for $1,000 of economic activity in the state of Maryland, you could be subject to collection and remittance obligations, and those compliance burdens may far exceed the amount that you've actually sold into the state. New York, on the other hand, takes the thresholds and says it's $500,000 in sales and 100 transactions, clearly quite different from that of Maryland. And the importance here is not that one standard is better than the other, but rather that there are two standards that are two standards among many that remote sellers and marketplace facilitators have to manage. We don't see uniformity in the area of safe harbors either. And safe harbors meaning how much time, how much grace is a remote seller or marketplace facilitator given to become compliant once the economic nexus thresholds have been met. We also don't see uniformity in how states define what sales are required to collect and upon which sales remote sellers, marketplace facilitators are required to collect and remit sales taxes. Some say it's a gross sales threshold, period. Others say retail sales. Some say taxable sales. Some include non-taxable sales. And still others have business-to-business inputs and business-business sales as part of this base of sales taxes that are required to have collection and remittance. Increasingly, we're starting to see states add non-sales taxes and fees to the requirements of remote sellers and marketplace facilitators. Two examples here in North Carolina and California. North Carolina, we see scrap tire tax, disposal taxes, white goods disposal tax, dry cleaning solvency taxes. California, a tire fee, an electronic waste recycling fee, a lead acid battery fee, and a lumber products assessment fee. And these aren't the only ones, but these are some that I highlighted in the country. So we're starting to see some fees and taxes added to the to the burden of compliance for remote sellers and marketplace facilitators. When it comes to the centralization of a sales tax administration, it is true that many states have, with some notable exceptions, have a centralized sales tax administration at the state level. There are some notable exceptions to that. But it is also true that there is a lack of centralization when it comes to these local taxes and fees that get tacked on to the sales tax base here, or the what's required for collection and remittance for remote sellers and marketplace facilitators. And lastly, for this slide, not all states provide a means through which remote sellers or marketplace facilitators can easily comply through software with multiple jurisdictions. And so they're left filing many returns or many exemption certificates in different jurisdictions. These are just some areas where we see a staggering lack of uniformity among the states, which presents some real problems constitutionally. Next slide, Tyler. So we have a paper forthcoming, the Tax Foundation, our team does, which will highlight primarily marketplace facilitators and some reforms that could serve marketplace facilitators and reduce the burdens placed upon them, as well as address some of the constitutional issues that arise by virtue of this patchwork of legislation. And to sort of key in on what the constitutional concerns are, we all know that Congress has the ability to regulate interstate commerce amongst the states, and states have their freedom, but it's not unfettered to levy taxes. Where states run afoul of Commerce Clause issues when it comes to the Constitution is either discriminating against or placing undue burdens on interstate commerce, and those lead to Commerce Clause concerns, constitutional problems, and are ripe for challenge or ripe for congressional intervention. So Congress in the past has taken up this issue of remote sales and marketplace facilitators, but has not advanced the ball too far. That doesn't mean it won't happen. It doesn't mean that Congress cannot legislatively override Wayfair. It does not mean that Congress could not potentially preempt state law, and those might not be desirable options for states. It might not be desirable options for the country. And so some solutions that might alleviate the current concerns are just suggestions. They're the providing of these CSPs, certified service providers, through existing software that can be easily integrated into existing software that marketplace facilitators, remote sellers are using to comply across all jurisdictions. Really using retail sales as the threshold for economic nexus, exclude business inputs, and eliminate all transactions threshold. We saw that in Louisiana this year. They moved away from the transactions threshold and now have an economic nexus threshold based exclusively on sales. States are encouraged to consider limiting the creep of additional taxes and fees and focusing exclusively on sales taxes. There is an issue in a lot of the statutes where it's unclear whether or not marketplace facilitators and remote sellers have the freedom to contract for obligations regarding the collection and remittance of sales taxes, particularly in those statutes where it's a shall statute, meaning that shall for the marketplace facilitator. They're the ones who are required to collect and remit the sales taxes in a particular jurisdiction. But in these places where we have additional taxes and additional fees, where the remote seller themselves that is using the marketplace facilitator platform may be best positioned to understand the obligations, it would behoove policymakers to consider specifically allowing the contractual shifting of the burden to make sure the correct party with the most knowledge of the issue is the one handling it and filing and collecting. Again, these are just suggestions. The next is the Wayfair court did address their idea that South Dakota statute passed muster because it did not retroactively penalize remote sellers. But states might also consider providing a grace period of at least 30 days for compliance. And for some smaller remote sellers, that may not be enough, but at least 30 days is a starting point. Some have called for a unified rate option for remote sellers, marketplace facilitators in each state, similar to that in Texas. And also the provision of a central clearinghouse option, whereby a remote seller marketplace facilitator could use the central clearinghouse option or pay, collect and remit to each individual jurisdiction. So those are that's the lay of the land. That's sort of where we are. That was fast. I understand that, and I'm sorry that I moved so quickly through it, but I want to get to the Q&A with Brad, because I know that's why everyone's here, and I'm looking forward to that. So Brad, again, welcome. Thanks so much for being here. As a former practicing tax attorney, I'm used to sitting across the desk from clients like you and having being close to on the ground, but not necessarily being on the ground myself. So your presence here is incredibly valuable. So thank you.
Well, thank you, Manish, for having me in today.
Yeah, great. So just to set the stage from your perspective, could you just tell us a little bit about yourself and about Halstead Beed?
Yeah, so my in-laws started Halstead Beed back in 1973. My father-in-law was the entomologist for the state of Arizona at the time, and he had always had an enormous interest in anthropological history. He ended up buying some Native American and African trade beads and brought them to work one day. And rather than just doing a show and tell, he ended up selling them to his coworkers. So he went and bought some more, brought those back, and sold those too. And he went home from work one day and he sat down with his wife, Susie, and he said, what do you think about stringing jewelry and going to craft fairs on the weekends? So Tom and Susie, with a 1-year-old at home, did what every American entrepreneur hopes to do. They sat down at the table and they figured out a way to do a side hustle. And for the next several years, they would string jewelry. They would go to local craft fairs down in the Phoenix area. And after a couple of years, they decided that there was a there there, that they had some potential there for themselves, and that they could gain some financial independence by working for themselves as opposed to continuing to work for the state. So Tom quit, and Halstead Bead was formed. They officially formed in 1975 under a C Corp. And from that point on, they sold jewelry. It was a couple of years later, after they'd been selling for a while, when they realized that selling jewelry itself was a means to an end. But what the real thing that they thought was, the area that they thought was going to be most promising for them was to sell components to other jewelers. And so they became wholesalers to other jewelers. And that was basically the genesis of the company in the early days. And by selling wholesale, they became a mail order catalog company. And then in the mid-90s, my father-in-law kind of saw the writing on the wall with the internet, and he started working on a website. And we were one of the earliest adopters for internet sales back in the late 1990s. And today we are entirely an e-commerce business online, selling to roughly 5,000 different customers in all 50 states and approximately 26 other countries. Tom and Susie are no longer in the company. They've retired. Their daughter, Hillary, is my wife. She is the president of the company. And as Tyler mentioned, I do all the accounting.
Well, that's great. Thanks so much for that that table set here. So prior to 2018, how much did you know about salt? Or
Zero.
Okay, so you just thought about it as a substance that raises blood pressure.
It was a condiment. I mean, I guess it's more. I don't even know what you classify it as in the food world. No, I didn't know what salt was. If you had said state and local tax department, I wouldn't have known that existed either. It was a world that was completely opaque to me at that point in time. And in fact, because we are wholesalers, we had no history whatsoever prior to 2018 in collecting sales tax from anybody. Outside of Arizona, because we didn't have a physical presence in any of the other states, we didn't collect sales tax. And within the state of Arizona, we had exemption certificates, and we call it a Form 5000A, to support the tax exemption status for all of our customers in state. So we had no sales tax collection capability.
Okay. So then this is sort of you coming into the company, or the company existing, and then 2018 happens, Wayfair is decided. Can you talk to us about what that was like, and how your world changed relatively overnight?
Well, we were watching the case as it worked its way through the Supreme Court. I foolishly didn't believe that the Supreme Court would rule the way they did. That being said, I have come to agree with the decision that they made. I just think that the rollout afterwards has been a little chaotic. But basically, our worlds were turned upside down. Going back to your salt example, if you look at Walmart opened their first store in 1962. And it was 1995 before they had a store in all 50 states. So they basically had a 33-year period to develop in-house expertise on state and local tax filing obligations in all 50 states, roughly 12,000 different jurisdictions. We had 101 days to accomplish the same thing. Now, to put that slightly into perspective, Walmart has 2 million employees. I don't know what they had in the 1970s and 80s, but they were building a salt department. Our entire company is 26 people. I think our entire company would fit into the corner of one of their salt department. And yet, if you look at our company, there were really only 2 people in the company that were able to work on this, my wife and myself. And it was my wife was looking at a lot of the legal angles, and I was looking at the compliance angles. And between the 2 of us, we spent 15 months developing our own internal state and local tax department with a party of 1.5. It's been I would say it was a heck of a challenge. I think the Supreme Court justices were informed that there was a free and easy software solution available to businesses like ours. We attempted to use that free and easy software solution, and it was one problem after another. It cost us almost $28,000 just to integrate our software with it, and that was doing it the cheap and dirty way. There was a long time after that where we had to continue to do programming for it. And then what we found out was within the first year of using it, we had 35 different complaints from streamlined sales tax states that the software wasn't doing the job it was promised to do. And part of the contract that we had with the software company said that these problems were theirs. But when you deal with the Department of Revenue in any state, they don't care what the software company is doing. They only care about the money that we're remitting. And because the software company was either failing to report or to remit on our behalf, that problem landed squarely in my lap. And I don't know if you've ever received a letter from the Department of Revenue or maybe the IRS, but when they come and it opens up and it says you're being assessed, the panic bells go off, your heart rate spikes, your blood pressure goes through the roof, and then you spend the next couple of days trying to figure out what's going on and trying to get the people who actually have the information to provide the information to that department, because frankly, we didn't have it.
Thanks, Brad. That's great. That's great context. So I want to back up a little bit to something that you said about the Wayfair decision, that not necessarily disagreeing with the result, but the implementation thereafter is sort of problematic. Mm-hmm. Could you describe to me a little bit more about that and your thoughts on the decision, not the rollout, but the decision itself?
Well, I think if you take a look at the tax landscape prior to the Wayfair decision, I'm going to use 12,000 because that's a common number. 12,000 different taxing jurisdictions across the country, and every single one of them had their own homegrown sales tax obligations built up. So in my local jurisdiction, Prescott, Arizona, I know exactly what is expected of me within the area. It's an 8.35% sales tax rate. I'm sorry, 9.35% sales tax rate. I know what I have to collect from my customers if they're walking in, if we even did that. And I know where to remit it. But I don't have the resources to go to 12,000 different taxing jurisdictions and to be able to understand at the same level of granular expertise what I do in Prescott. So I think the Supreme Court heard software, and unfortunately, I think a lot of people think software is the solution to everything. And if we've learned anything in the last 30 years, software solves some problems but creates others. And one of the big problems it creates is the expectation that perfection is at your fingertips, and it oftentimes is not. And I think the Supreme Court heard that there was a software solution. They heard that that software solution was going to do the job, and they accepted that at face value. And then when we experienced what was really available to us, it was either prohibitively expensive or completely inadequate. And for a small business, that was our experience largely.
Yeah, and do you have any thoughts on the court in Wayfair spent some time focused in on treating identical actors or similar actors similarly in the economy, meaning that if you're a remote seller like yourself, you shouldn't be privileged by not having to collect and remit sales taxes by virtue of being in Arizona versus the retailer who's in Minnesota. Did you have thoughts on that at the time, or do you now?
Yeah, I mean, it's always been known to the consumer that it's cheaper to buy online. And so as a seller online, we did have a competitive advantage over brick and mortar sellers. And that wasn't fair. That needed to be rectified. And I think Wayfair was a step in the right direction. But the problem is, rather than accepting the fact that the entire marketplace had changed, not just the way you buy products, but the way products are sourced, the way products are distributed, everything had changed. And it was all made possible by the internet. And businesses have to evolve to be able to exist and to prosper within that environment. And so we're constantly changing our business practices. We are constantly looking at our competition and saying, okay, what are they doing that's better than us? How can we change to adapt to that? How can we improve? How can we make the experience better for our customer? And I think that is half of the equation. And when you take a look at the sales tax environment, those 12,000 different taxing jurisdictions have never been in that situation. They've never had to look at the neighboring taxing jurisdiction and say, they're doing it better than us. How can we improve? Because they had a captured audience. If you lived in their jurisdiction, you had a physical presence in their jurisdiction, you had an obligation, period. Recognizing that there are 12,000 different taxing jurisdictions, I can't even understand the demands of 12,000 different customers. We've got 5,000 and they all want something different. So how do I serve them? I simplify. I make things uniform. And I think the Supreme Court assumed that the software was going to do that job, when really the hard work has to happen at the ground level. It has to happen in the taxing jurisdictions themselves. They have to take a look at this and say, look, I know what I can expect of the corner market down the street from me, but is it fair, or could I understand what the corner market on the other side of the country is dealing with? Probably not. And so how do you streamline those systems to recognize that it's 50 different 50 different departments of revenue within the states? Then you've got the District of Columbia, and then you've got localized jurisdictions which still hold prominence in Colorado and Alaska and Louisiana. And you've got to say, okay, is it a fair expectation of a small seller to be able to understand not just their home jurisdictions and not just my home jurisdiction's tax expectations, but all 12,000? And I think if you start to look at the scale of the issue, then the Supreme Court really did miss it, because software isn't going to solve this. It really does need to come down to a unified, simplified tax regime at the the localized sales tax level. And if they work together, what I ultimately think they're going to find is greater compliance and probably greater efficiencies built in, not just to the businesses that are having to comply, but also within those taxing jurisdictions themselves, and be able to eliminate some of the administrative costs that they're experiencing, which do demand funding, and then being able to use those funds that they generate into projects that are going to benefit their local jurisdictions. I hope I answered your question. That was all over the board.
No, it was great. Thanks, Brett. The question I have for you is, I've often talked about compliance and simplicity. Simplicity is one of Tax Foundation's principles of sound tax policy. Potentially could result in greater compliance, as you mentioned, but also a greater sort of intake of sales tax revenue to the states. Is that something that you would adhere to?
Well, it's interesting. I've been talking to a lot of business owners for the last several years, and what you hear over and over and over again is, I don't want to be out of compliance, but I don't know how to, or I didn't even know that I was supposed to be complying. And I think there's been a real communication gap there. There are still a lot of businesses that are not aware of the Wayfair decision, which is hugely problematic just from the liability standpoint. But for those companies that are complying or would like to comply, they look at what they have to deal with. And I know for us, we've spent $423,000 on compliance in the last 5 years. We've put 11,500 hours of company time into compliance. And for that, we've generated about $167,000 in sales tax. So we're spending $2.54 for every dollar that we collect. And if you bottom line that as a business owner, that is a huge burden. It doesn't make a whole lot of sense, especially when the reality is we're just trying to send money from the customer to the Department of Revenue. It really should be a pass-through, but at this point in time, it's not a pass-through. It's a take it in, manage the living snot out of it, and then turn around and try to get it back to the Department of Revenue. And the inefficiencies that are currently in the system are burdensome, to say the least. But I think they're also a big turnoff to a lot of companies, just recognizing that they don't have the expertise, and they're hoping that Congress is going to address this. And I think that's kind of it's baseless hope. But the reality is there are a lot of companies that still believe that Congress is going to take care of this.
Yeah. I know you've sort of run the numbers or extrapolated out a little bit. Could you provide some context to those hours per for your company, and how that might look at a larger scale if we were thinking about, say, an Amazon or a Walmart?
Sure. If Amazon was putting the same number of hours, hold on, I have to find my sheet here because I love these numbers. We've spent 11,500 hours, $423,000 on this. If you were to use a ratio and extrapolate that out to Amazon or to a Walmart, Amazon would have put over 729 million hours into compliance, and almost $27 billion into the expense of it. Amazon being Walmart being a larger company is over 1 trillion hours, and they would be about $37.5 billion in compliance. If they were experiencing numbers like those, I'm pretty sure that they would be knocking on the doors of every legislator from the local all the way up to the federal level, but they're not. They've got economies of scale that help them to benefit from this, at least competitively speaking, whereas we don't have those economies to draw from.
So I sort of mentioned in the opening here that Congress took it up a little bit. They've at least looked at a few different bills: the Marketplace Fairness Act, the Remote Transaction Parity Act, the No Regulation Without Representation Act. Those acts didn't make it out of the gate too far. And this area, seemingly, in my opinion, is ripe for some level of greater oversight, whether it's from Congress, obviously, whether it's preemption, I should say, or a legislative override of Wayfair, which neither one may be favorable to state legislators who may be listening on this call or otherwise. And so, outside of the compliance burdens, are there any other pain points that you're seeing? So compliance, obviously, the filing and the tracking. But when you and I spoke last time, you talked about the potential risks to a business, and how does this impact, say, entrepreneurship from your perspective?
Well, let's talk about three different areas. You've got expertise, which is brain power. You've got software, and then you've got liability. So let's go into the expertise first. We're a small business. We understand jewelry components. We understand the jewelry industry. I am not a tax attorney. We don't have access to a tax attorney, and our CPA here locally is not qualified to handle interstate sales tax. So we are basically at a service gap because we're a small business. So we spent a long time working on building out our expertise on understanding our compliance obligations in all 50 states. It's not a task that we would like to repeat, but we have to continually upgrade it because, as you know, the legislative cycles bring new legislation every single year, and so the rules are constantly changing and updating. So that expertise, that's a real problem for a small business. We can't afford high-level expertise, outside expertise, and we certainly can't afford to bring it in-house. So we struggle in that area. The software, like I said earlier, the expectation is that it solves everything, but it doesn't. And oftentimes it's a lot more expensive than people understand. Integration with existing legacy software is not always easy. I know of companies that have spent $500,000 to integrate sales tax software into their existing systems. Ours didn't cost that much. Over the last 5 years, we've done a few rounds now, and I would estimate that we spent about $65,000 total in integrations, but $65,000 is a lot of money for a small business. That's more than we pay our median or average employee here at the company in an annual year. So the software is always a problem. Anytime I hear somebody say, well, you can just plug it in, it's plug and play. It's not true. There's no such thing as plug and play software. Maybe if you operate completely within a marketplace facilitator, that option exists. I don't know because we don't do that. But when you're an independent operator that prizes its own autonomy, then you've got lots of different software solutions that you put into place to manage all of your different customer relations. And then adding this on to it, it's not cheap. A lot of those softwares pay for themselves because they bring efficiencies or improved customer service. Sales tax software does neither. So it's just a sunk cost for us that we have to endure. And then the liability. The liability is actually, my wife and I spent all of 2019 debating whether or not we wanted to keep Halstead Beat open. We were thinking at that time that we were not sure if we were going to be able to manage this. We didn't know if we were going to be able to do it well. And I'll get into that in a moment, why we were convinced at the end of the year that we should. But the reality is, if you're looking at the liabilities from this, sales tax is a trust fund tax. I collect it from my customer. I hold it in trust for my state's Department of Revenue, and then I remit it to my state's Department of Revenue. If I fail to collect, if I fail to hold it, and I fail to remit it, I've committed a crime. So under normal circumstances, if the company messes up and the owners are working there, or maybe they're not working there, my in-laws don't work here anymore and they're still a majority stakeholder. If we screw up our sales tax compliance in a way that draws a large assessment, if the Department of Revenue, or perhaps 45 different departments of revenue, come to us and say, hey, you need to pay us, we're going to have to start emptying our coffers here at the company. And if the assets of the company are insufficient to cover those assessments, now we're going to go to our houses We're going to go to our retirement accounts. We're going to go to our kids' college funds. We're going to have to go into our own personal assets because the corporate veil that typically protects the owners from the misdeeds of the business no longer exists in this realm. Now, if you think about a lot of companies in this country, I mean, we are a very leveraged society. Everybody has debt at the personal, at the company level, it's everywhere. If my company, I'll throw some numbers at you just to kind of put this in context for the last 5 years. If we were unaware of the Wayfair decision, or we had decided not to comply, which was never our problem, but that is the issue for a lot of companies, which is why I'm bringing it up. So if it was us, we've done about $32 million in sales since the Wayfair decision. In that time, the sales that we sent into states where we meet threshold is approximately $19 million. Using an 8% average sales tax rate, that means we would owe about $1.5 million in sales tax to all of the different states where we hit threshold but had failed to collect. Now, I don't know what penalties and interest are on this sort of thing, but I know they're punitive. So let's just assume it amounts to $500,000. So that's $2 million. The assets at Halstead B today are about $1.5 million, which means I'm $500,000 short. So fire everybody we got, liquidate everything we got, get rid of the company. It no longer exists. That's 26 jobs out the door. Now they're going to come after me for my house or my retirement account or whatever I have saved. And they're going to do it ruthlessly because that is the nature of regulations. It's not, oh, I feel bad for this guy. It's, these are the way the rules are written. I have to do this. And I understand that as a business owner, that's the nature of the beast. But that's what a lot of companies are facing, and it's terrifying. Now, going back to what I mentioned earlier about why we were able to sleep easy at the end of 2019, Hillary and I spent $25,000 with one of the big 6 accounting firms having a complete audit of our processes done. And at the end of the audit, they said, you're doing well. You're doing really well. In fact, not many companies are doing as well. Here are our recommendations. Keep doing what you're doing, but put away a bunch of money because you are going to get audited. It's not if, it's when. And there is nobody that can survive an audit without being assessed. It just doesn't happen. So put a bunch of money away, keep that money aside, and when you get assessed, you'll be able to pay it. That's a hugely terrifying fact to be faced with, especially when you don't know where that audit is going to come from. Is it going to come from Vermont? Is it going to come from Alaska? I don't know. I never know where it's going to come from.
Yeah, thanks, Brad. That actually leads to a question we received in, and the question relates to transparency. Has there been any progress made in transparency or otherwise that makes it easier for small and medium-sized businesses to comply, or to take that another way, maybe add some of your policy your policy thoughts there? I know you and I have spoken at length about things. I've written a paper that's coming out about marketplace facilitators. Some of those recommendations may or may not apply to remote sellers, specifically with respect to the software, which I agree with you that it may make sense for marketplace facilitators. But have you seen any progress on the state front to make it easier for companies your size or smaller to deal with?
Not really. In the 5 years since the decision, we've only been notified by one state that we may or may not have a collection obligation. If there's any listeners from Pennsylvania, thank you. Your state actually did that for us. No other state has. So basically, we had one notification, one piece of outreach from a state where we didn't have any history collecting with. Every single year, legislatures change the rules. Departments of revenue update the expectations and whatnot, and we have to go out and independently seek out those changes on state departments of revenue website or within state legislative text bodies. We're not really qualified to do that. We've become better at reading legalese, but that's not our area of proficiency. There is no central source that can tell us exactly how to comply with every different state that we are familiar with. And the reality is a lot of small businesses, they don't look beyond their home state's borders. I receive notifications from the Department of Revenue in Arizona. This update has occurred. This update has occurred. I received them from the IRS, but until I registered with the other states, I never received any sort of notification. And even now, they're kind of strange notifications that we use outside software for some help with. But there is no centralized source. So it's kind of whack-a-mole. And that's another thing. The pace at which these developments occur is sporadic and inconsistent. And so, I may have to check Pennsylvania next month, or Texas the month after that, or Arizona is going to notify me, so I don't have to worry about them. But name your state. California sends me things all the time. Michigan is notorious for sending me updates that frankly don't have a whole lot of bearing on our company, but I get buried in paperwork from the states that I've registered with, but I never receive information at all from states where I've never registered. So no, there's not really a centralized database, which would be helpful. I think it would cut down on communications from two different perspectives. From the business perspective, if I knew that I was going to have to only go to one resource to get all of my information, then I could go there on a regular basis and update my policies and procedures. And with the states, if the states had a central body that they could go to and say, please put our new updates here, please inform all of your businesses across the entire country through this central clearing center, or whatever you want to call it, that would be helpful. And I think if the departments of revenue talked to each other and generated a central clearinghouse for information, for registration, for filing, for remittance, and all of these different things, it would dramatically simplify not only their workload, but the business workload too, which would help bring down costs. And those costs are substantial.
Yeah. From your perspective, and I'm curious, do you see, I guess the question I have for you, you're a remote seller, and you've articulated very clearly the costs of compliance. Why not just go put Halstead bead products onto a marketplace facilitator and let them absorb the compliance costs and take yourself out of the game?
Well, you brought up Amazon at the beginning as a marketplace facilitator. They're very famous. They've got their fulfillment by Amazon, which allows for easier distribution and easier customer acquaintance, but there are costs to that. Firstly, they own your customer list. Secondly, they ultimately own your supplier list. So basically, you've made yourself an independent or you've converted yourself from an independent operator to a dependent. That is unappealing to us. Now, the cost side of it, there's a range. The number that always seems to come out most often is about 23% commission rate. So that's kind of a funky number. I'm just going to use 20% for argument's sake for today. We're on track to do about $6.7 million this year in sales. So that's about $1.34 million in commission to Amazon if we decide to use them as our marketplace facilitator. Now, yes, it would cut down on the $58,000 that we expect to spend on sales tax compliance, but $1.34 million is not a good return on investment. But that's just the beginning of it. Our entire payroll for our company is about $1.2 million. So I'm either going to have to increase my costs sufficiently enough to offset that commission to keep all my employees, or I'm going to have to start cutting my employees. And even if I cut every single one of my employees, including my wife and myself, and left this as nothing but a shell, we still are spending more on that commission than I do on my payroll. Now, that does not help the local economy. There is no Amazon center here. We pay our people as well or better than Amazon in most cases. And so I fail to see how that helps my local economy when the reality is this company was set up for the opportunity to be independent in the first place.
Yeah, thanks for that, Brad. So, we talked earlier about centralization being an issue, and there are some outliers there. You mentioned Colorado, Louisiana still lacks some, and I know you've had some engagement with the state of Louisiana and Alabama and Alaska as well. Alaska not imposing a statewide sales tax, but the local municipalities can, and so there's some real lack there. So I highlight that there are some outlying jurisdictions with home rule jurisdictions or otherwise where compliance becomes all the more difficult when there is a real lack of centralization in the administrative process. Just to sort of plus onto what you were saying there. I did have a question for you. We actually received a question in, and you and I chatted about it earlier. It's about the Quill case, and the question is, wasn't the most serious drawback from Wayfair being the erasure of interstate tax competition by erasing virtual borders that were established by Quill. And just to back into that question sort of highlights the progeny of cases that led to Wayfair. So going all the way back to Bellis Hess, which is a mail order company sending catalogs and fulfilling orders. The Supreme Court said the purpose of the Commerce Clause was to prevent this type of local entanglement, preventing Bellis, requiring Bellis Hess to comply with the local use taxing. No, that's too local. Commerce Clause was designed to not do with it. A later case was Complete Auto, which was a Michigan transport company that was sort of picking up cars in Mississippi off the rails and taking them over to local dealerships. And the state of Mississippi tried to assess them some taxes related. And the court in that case highlighted a four-part test. And that one of the steps in that four-part test, one of the prongs is substantial nexus within the state. And that was really what the Quill Court, which is a later court in 1992, held on to, another mail order company, but basically said that essentially substantial nexus is physical nexus. And that particular point is what the Wayfair Court took very, very short within the opinion, but was very careful to articulate that that physical presence is not necessary for substantial nexus. Mm-hmm. And I'm just curious if you had any thoughts on that in relation to the question that we got.
Well, I think substantial nexus, I've actually not heard that before, but I like the term because I think substantial nexus indicates to a layperson like myself that there is a substantial presence within that taxing jurisdiction. The physical presence would argue for that. If you've got inventory, property, or employees in a jurisdiction, then you've got physical presence. But again, we're in a different age than 1992. I think 1992 was a nod to stare decisis. It was an acknowledgement, tacit or overt, of the Pike test, the balancing test, stating that the burdens on a taxpayer cannot exceed the benefits to the taxing jurisdiction itself. And it was a nod to Congress that this is within their purview, that they need to weigh in on this. The Commerce Clause expressly dictates to Congress that they have the authority to regulate interstate commerce. Now, Congress never did. They didn't take it up. They demurred for 26 years, which is why we ended up with Wayfair. I think that substantial nexus argument is probably something I would like to look into further, because I think substantial is a scale. It's a sliding scale, and it's very eye of the beholder. Do I have a substantial physical presence in Arizona? Absolutely. Do I have a substantial economic presence in California? Yes, in some ways. But do I have a substantial enough nexus within California to have to be completely conversant on the taxing jurisdiction's expectations of 401 different taxing jurisdictions? I think that might be a spurious argument. And I think if California or many of the other states were to take a look at that and say, yeah, they're not the equivalent of a physical presence company. Why don't we take a look at our tax code and just simplify this for everybody? Let's make it even for everybody. Let's simplify it dramatically for everybody. And let's just really focus on efficiencies of tax policy instead of territorial disputes, which is kind of what this feels like from a small business perspective.
So in the few minutes we have left, let's get to some of those simplicity issues, and we'll get to some of the policy proposals that you have and the ones that I've suggested. The first one I want to get to is thresholds, particularly the transaction threshold, which I would argue is the opposite of simple, frankly, because in my Maryland example, it takes $1,000 in sales to meet the threshold, or $100,000. $1,000 in transaction sales versus $100,000 in sales. Would you agree that, at least at an outset, getting rid of a transaction threshold is a good starting point?
Absolutely. There are a lot of companies that make $4 and $5 sales online. How many $4 and $5 sales does it take to establish economic nexus in a state? I don't know that 200 is the right number. And frankly, those numbers are kind of strange, especially when you consider a company like ours. The vast majority of our transactions and sales are wholesale. We don't even collect sales tax on the majority of our sales. So I think the transaction count, I don't know where it came from. I know it came out of South Dakota, but I don't know exactly who thought that was a good idea. A lot of states have abandoned it, and I think they're moving in the right direction, but I think seeing that nationally would be the best option.
Great. You've mentioned a national central clearinghouse option. I'm curious if you could describe that a little more.
Well, yeah, let's look at precedent because it's always important. In the 1980s and 90s, the International Fuel Tax Agreement came into being to help long-haul truckers with their fuel tax reporting expectations. It has dramatically reduced the amount of work that the truck drivers have to put into just to report their fuel taxes back to the states. It's made life easier for the states, and there's a central clearinghouse to which those truck drivers report and to which the states receive and report as well. Is cut down on that communication. So it does exist already. A lot of the states have gone so far as to create a centralized body within their state for companies like ours to deal with, but there's still 45 states. There's Alaska, there's the District of Columbia, and frankly, a lot of other countries are starting to do this now. Wayfair has gone international. So that's still 45 different bodies potentially, or 47 that I have to deal with each month, which I've got a lot of obligations here. I wear a lot of hats. It's a lot to do for a small business owner. And the expectation is that I can manage accounts payable, I can manage receivables, I can manage payroll, I can manage benefits administration, I can manage our contracts, and now I can manage all the sales tax with 45 different partners. That's a lot of partners. We don't even have 45 suppliers. So if there was a centralized clearinghouse, and that's the terminology used by the International Fuel Tax Agreement, it could be something else. But if there was some centralized body that states and businesses could, report and communicate with, it would be significantly easier for us to comply. And again, I think it would be easier for the states.
Great. Thanks so much, Brad. I know we have a lot of questions and we're really short on time. So I see Tyler back on the screen, so I'll turn it over to Tyler.
Yeah, let's close things out, Brad. I mean, I think the number that sticks in my mind was, what is it, $2.30 for every dollar that you send to the State Department is what it costs you?
Well, it's $2.54 now. It was $2.30, but our retail sales have dropped off by over 40% in the last couple of years. We're just a wholesaler. I mean, we're on track to do about $305,000 this year in retail sales. So we're going to collect, I estimate, about $12,000 in sales tax, and it's going to cost us $58,000 to do that. We're going to do about $6.7 million in sales overall, but only $305,000 of that is retail.
Insane. That's absolutely insane. Well, I want to thank Manish and Brad for joining our conversation today. As I said, the recording for this will be released on our website, as will the slides. If you have any questions, please feel free to reach out to me, parks@taxfoundation.org. If you'd like to talk to Brad or Manish further about the topic at hand. But I'll sign off here. Like I said, thank you everybody for joining, and have a great rest of your afternoon.